IAS 41 Agriculture establishes the accounting principles for agricultural activity, focusing specifically on biological assets, agricultural produce at harvest, and certain government grants related to agricultural operations. The standard applies to activities involving the management of biological transformation, such as the growth, degeneration, production, and procreation of living plants and animals. Examples include livestock farming, forestry, plantations, vineyards, and crop cultivation. IAS 41 was developed because agricultural activities involve continuous biological changes that significantly affect asset values and profitability. Traditional historical cost accounting was considered insufficient for reflecting these changes accurately. The standard therefore emphasizes fair value measurement to provide transparent and relevant information regarding the economic effects of agricultural transformation and market conditions within financial statements. The scope of IAS 41 covers biological assets and agricultural produce at the point of harvest but excludes land, intangible assets, and processing activities after harvest. Biological assets include living animals and plants controlled by an entity as a result of past events and expected to generate future economic benefits. Agricultural produce refers to the harvested product obtained from biological assets, such as harvested crops, wool, milk, or timber. Once harvested, agricultural produce is treated as inventory under IAS 2 inventories rather than IAS 41. This distinction is important because different measurement and valuation rules apply after harvest. Understanding the scope of IAS 41 ensures that entities apply the correct accounting standards consistently across agricultural operations and related business activities. IAS 41 requires biological assets to be recognized when the entity controls the asset, future economic benefits are probable, and fair value or cost can be measured reliably. The standard generally requires biological assets to be measured at fair value less costs to sell both initially and at each reporting date. Fair value measurement reflects current market conditions and the biological transformation occurring over time. Gains and losses arising from changes in fair value are recognized immediately in profit or loss, unlike many other non-current assets measured using historical cost models. This treatment improves transparency and ensures that financial statements reflect ongoing biological growth, market price changes, and operational performance realistically within agricultural businesses and related industries. In limited circumstances where fair value cannot be measured reliably, IAS 41 permits biological assets to be measured at cost less accumulated depreciation and impairment losses. This exception usually applies during initial recognition when market prices or reliable valuation methods are unavailable. However, once fair value becomes measurable reliably, entities must switch to fair value measurement. The standard strongly favors fair value because biological transformation significantly changes asset values over time, making historical cost less relevant. Immediate recognition of gains and losses resulting from fair value changes can create earnings volatility, but it provides more timely and relevant information to investors and stakeholders regarding agricultural performance, productivity, and exposure to changing market conditions affecting agricultural assets and produce. Government grants related to agriculture receive specific treatment under IAS 41 because agricultural industries often receive financial support from governments. Unconditional government grants relating to biological assets measured at fair value less costs to sell are recognized in profit or loss when receivable. Conditional grants are recognized only when the attached conditions are satisfied. This treatment differs from IAS 20 government grants because IAS 41 specifically addresses grants linked directly to biological assets. The standard also requires extensive disclosures regarding biological assets, valuation methods, fair value changes, restrictions on ownership, and risks associated with agricultural activities. These disclosures improve transparency and help users understand the financial effects of biological transformation, government support, and market volatility on agricultural operations and profitability. Overall, IAS 41 provides a specialized framework for accounting for agricultural activities and biological assets within international financial reporting. By emphasizing fair value measurement and immediate recognition of gains and losses, the standard ensures that financial statements reflect the dynamic nature of agricultural transformation and market conditions accurately. The distinction between biological assets and harvested agricultural produce helps entities apply appropriate measurement principles throughout production cycles. In addition, specific guidance on government grants and disclosure requirements enhances transparency and comparability within agricultural industries. For DIP IFR candidates, Understanding IAS 41 is important because agricultural accounting differs significantly from traditional asset accounting and requires careful application of fair value principles, professional judgment, and sector-specific IFRS requirements.